everybody, welcome back to the Global Fund Voyage podcast, where we navigate through the world of investments and market insights. I'm Juliana.
And I'm Marcus.
And today, we are thrilled to bring you a very special episode on US elections. With now Trump being back in office, I guess the big question everybody has is what's next for the global markets?
And today we have invited a very special guest, our own investment director with 30 years of experience, and he kind of forgot that he's supposed to wear smart casual, so we look a little bit off in terms of attire. We have Kenny here today. Kenny, will you give a short introduction of yourself?
Yes, of course. My name is Kenny Tjan. I'm the investment director at iFAST. Thank you for just saying I have 30 years of experience. In fact, it's more than that because I actually started in 1991, so it's like 33 years now. But anyway, my role has been kind of like expanded across multiple firms. So I worked at Goldman, I worked at Nomura, Rothschild, and also set up my own boutique investment firm. The last stint was at Value Partners before joining iFAST.
Thank you, Kenny, for introduction. I guess today, now we'll start with the conversation proper. I'll ask Marcus first. What are your thoughts on the Trump's win and the broader political landscape?
Yeah, so Trump had a landslide victory, where he won all three races, president race, he won majority of the Senate and majority of the House. I guess that has some kind of implications where he can easily implement, the policies that he wants. But if you look at really just the broader picture, if you really look back into history as how, elections actually affected markets, we had about 24 elections. So if we look back from 1926 all the way to 2023, and out of those 24 elections, only 4 election years resulted in negative returns for markets. And coincidentally, these 4 years actually had major economic events that actually caused the markets to, achieve negative returns. One of them was actually coincided with the Great Depression, then followed by World War II, GFC, and also the dot-com bubble. So if you want to really talk about do presidential election years really affect markets, it kind of seems like that's not really the case. Markets do move on their own, and it's usually this kind of major market events that actually affect markets in general. But in terms of what kind of person he really is, you can see he's a very pro-business person. When he was running for his campaigns to say, I'm gonna cut taxes, I'm gonna implement tariffs on imports coming into the US. He seems like some very aggressive person. But if you really look into what he wants to do and his reasons behind all this, is that he's actually very protective of the US. He runs the US as sort of like a business, and he wants to protect domestic businesses in the US. So generally, I think with him coming into office, it looks to be a pretty good term, or at least an environment for at least US equities in general.
Maybe, Kenny, next question to you. How do you think Trump's election will impact the financial markets?
Yeah, I think I agree with what Marcus has mentioned. Trump is a very pro-business guy. And you look at the risk asset. Since his victory as the president of the United States, and in general, we have seen the MSCI World going up by 3.5-4%, the S&P 500 and Nasdaq going up by almost 5%. So I think what we are seeing is that investors actually cheered that Trump has been re-elected as the 47th president of the United States, and I think there is a bit of euphoria in my opinion, but that I think is largely tied to his kind of like campaigning agenda by tax cut, America first. So the US still dominates the world. So as a result of that, as the US economy does well, the US market does well, it kind of have a spillover effect to the rest of the world.
So Kenny, on that point, US is about to do well, but there's always this phrase when the US catches a cold, everyone also catches it as well. With markets running with this euphoria, is the US markets a little bit too optimistic in terms of where they think they're going?
Yeah, I think it's very hard to predict short-term movement of the market. So the current euphoria that you are seeing in the market, of course, I think partly attributed to optimism about what Trump is likely to do. But I think more importantly, if you focus on the earnings growth in the US, they are still very, very strong. You look at the drivers of the market, which a large part has been technology. I mean, technology innovation has been in the forefront of a lot of US companies. So as a result of that, on one hand, we can say that the market may have overshoot in the short term, but the underlying fundamentals are still pretty strong. And US companies are now truly global companies. I mean, even you look at simple, like Netflix, which you may not associate with, technology or whatever, is like consumer reach. They are reaching all over the world. I mean, I'm not sure how everyone here is, whether they are subscribers of Netflix. Personally, I am, and they do have very good program. So sometimes it's a good distressing kind of avenue for me to take a look at Netflix program, and then So I would say that with the US dominance in this global scene, it is likely that investors will still look at the US market very keenly, and that definitely has important ramification to the rest of the world.
Kenny, then what do you think, with what shifts can we expect in Trump's domestic policies?
I think as Marcus has shared, Trump is a very truly American first kind of president. So that's why I think it will be good for the US economy, and that's why we are seeing the current euphoria that we are seeing in the US. But I think more importantly, there are certain segments, like for example the manufacturing segment in the US, even the financial sector, and he's kind of very prone towards making it easier for Americans, making things harder for the rest of the world. So I think that's the kind of the mindset. So anything should benefit American first. So even on financial regulation, I think we are seeing perhaps less stress on perhaps the provision that the banks need to make in terms of the financial capital requirement, and also things like tax cut that I think Marcus has mentioned about. We know that he has kind of like campaigned that he will reduce the corporate tax rate to around 20%. I'm not sure whether that will materialize, but if it materializes, definitely it will be a big boost to the corporate earnings of the US market. I think part of the reason why the US market is doing so well currently, and I think there's a lot of people saying that the US S&P will reach like 6,005, 6,006 by the end of 2025. And I think if earnings continue to be the underlying drivers, I think there's going to be very good kind of underlying reason for the market to do well.
So we talked about tax cuts, positive for corporate earnings, deregulations on the financial sectors. When it comes to Trump's tariffs, I think we all know recently that he announced that on the first day of office, he's going to implement tariffs on Mexico, Canada, and even China itself. Isn't tariffs a little bit counterintuitive, as it increases general prices in the US and that affects consumers as well?
Yeah, I think you're right. That's why I said it's good for the US in terms of the policy that's implementing to the US, but in terms of the policy that he's implementing towards the rest of the world, that may not be as positive. And in particular, China has been unfortunately the main target. I mean, whether it's Trump or whether it's the Biden administration, we have seen that a relentless effort of trying to curtail technology, especially on the advanced technology space that China can develop. So they, as much as possible, try to restrict that, and in the forms of or in the words of unfair competition, unfair subsidy, they justify by implementing a lot of tariffs. I can't really tell whether there's any solid grounds as to whether like for example in the EV space, there's a lot of tariff discussion saying that China is unfairly supporting the EV industry. But having said that, I think against China will be one of the key Trump policy that I think investors will have to look forward to, unfortunately. But having said that, I think investors are also kind of used to that. So it's not like something surprising. So as a result of that, I think the likely consequences may not be as severe. In terms of the impact to the global growth, I think there was an estimate that I read from IMF is that if the full scale of the Trump tariff implementation would take place, it may potentially shout off like 0.8% for 2025 growth and 1.3% for 2026 growth. But these are just numbers, because I think the extreme case of the tariff implementation may not exactly be implemented, so it's kind of somewhere in between.
Yeah, I do agree as well. And I think his recent announcement on the tariffs, I did also read that he tends to use this tariffs as a bargaining chip. He gets to get countries to actually do some negotiations with him. So I think also what I read was that after announcements of the proposed tariffs, he actually had a call with the Canada PM, immediately to discuss about all this. So I guess the main point is that, Trump may have some radical kind of policies, but implementing it may not be the case. He may not easily implement all these kind of tariffs, as there could be some pushbacks.
Maybe next, let's talk about the potential sectoral impacts of Trump's policy moves. How, in your view, maybe Marcus, how do you think sectors like technology or like other sectors that you think will respond to this?
I'm going to take a different approach to answering this, and I would say that it's kind of difficult to really determine which sector would do well. Then if you compare the past presidents, so most recently Joe Biden and also Trump when he was in the first term of his office, Trump is more very traditional energy guy, coal, fossil fuels, and Biden's on the other side of the coin, he's more EV, pro EV. But during Trump's first term in office, actually the EV sector actually did a lot better compared to the traditional, energy sector. And when Biden took over, it was the other way around. Like traditional fossil fuel companies or energy sector did well, and EV sectors actually did poorly. So I think if we come to, at least my conclusion is, if you try to make some decisions based on who's running the country or who's the president, we tend to make these kind of mistakes because the markets will still move irregardless of who's running the country. So when Trump was in office in his first term, the EV sector did very well because generally what you saw was very low interest rates environment. And these EV vehicle companies, they are very capital intensive. So low interest rates just means that they are able to borrow at much lower rates and expand their businesses. Then if you fast forward to Biden's time in the office, it was when we had the COVID-19 reopening. So that led to the first surge in inflation. And then you had the geopolitical tensions between Russia and Ukraine. That also led to a surge in oil prices. So that's why, these traditional energy sectors, did well. So I guess for me, I'm not going to make much, bets in terms of which sector will be doing well. I'll just buy the S&P 500. Yeah, so that's my conclusion.
Okay. What about yourself, Kenny?
Yeah, I think to a very large extent, I agree with Marcus. We're trying to cherry pick which sectors will benefit is quite difficult from let's say investors out there, and I think it's important to kind of differentiate what is the real kind of investment case that you would like to put your own money into, right? So as I mentioned earlier, the underlying fundamentals to me will be the key drivers of a share price going forward. So there could be thematic change at times, like EV was in favor, EV was out of favor, but ultimately, can EV companies make money? I think that to me will be the most important consideration if one were to invest in, let's say, the EV companies. So I think in the US, as I mentioned earlier, there's a lot of global companies. There's a lot of quality companies with very solid fundamentals, with very strong underlying earnings growth potential. So a lot of people, would like to talk about Nvidia, for example, but a lot of people think that Nvidia is very expensive. But you look at the dominance in the AI space. When I was actually looking at Nvidia 30 years ago, in fact, close to 30 years ago, Nvidia was just supplying a lot of chipset to the traditional, those PC games, the sound, the sound system and all the other stuff. It has actually transformed itself to the dominant force in the AI chipset space. So I think if you look at the progress of such kind of company, I think ultimately when you invest in this kind of company is the kind of future earnings potential that you're looking at. So I think in the US, you can actually find a lot of these companies, whether they're big companies or whether they are emerging companies. So that's why I think the US market will continue to be attracting a lot of capital inflow into the US stock market, or even the US treasuries is also have been attracting a lot of money, and with the current high interest rate environment, they are likely to continue to remain as an attractive asset class. So in short, I think rather than trying to decide, should I invest in EV, should I invest in consumer, should I invest in fossil fuel, I think you should just think on the broader scale. Let's say if you think that a certain market or a certain region will give you potential, like even investing in the S&P 500 will actually give you very decent return over a longer run period. But for those investors who still like to cherry pick, I think there are a lot of funds out there that actually focus on certain sectors, and also ETF that's focused on certain sectors that allow investors look at. I'm not trying to pitch the iFAST. iFAST as a platform does offer a lot of this kind of opportunities for investors to exhibit their selection skill. But for those who just are more conservative and just like to have a long-term exposure to certain economies, we also have a lot of that kind of instruments available in the platform.
Thank you, the both of you, for sharing your answers, your questions. Maybe lastly, I'll ask the both of you if you have any closing statements or forward-looking statements for our investors out there. Maybe Marcus first.
Yeah, so I can summarize in 3 key points. Firstly, don't make any rash decisions based on who won the US election or in general, because generally the common theme that you have heard in this episode is stock markets, they tend to run over the long term based on their earnings projections and their revenue growth. Second point is diversification is very important. Although the US is projected to do very well, with Trump actually inheriting a very healthy economy, it's also prudent to practice a little bit of diversification, as you're able to capture other sources of returns outside the US, which are also relatively attractive as well. And lastly, just the final point is that don't panic, stay invested, and stay disciplined in the market.
Kenny, yourself?
Yeah, I kind of agree with Marcus. But I think one of the things that I may like to add is that, as I mentioned earlier, the world market or the US market has currently undergone quite a bit of euphoric rally. So should not be surprised. Investors should not be surprised that there could be a potential pullback in the market. But again, I think for investment, I have always been advocating taking a longer term perspective. And I think you heard a lot of those Warren Buffett saying, right? Be greedy, when everyone is anxious, and then be anxious when everyone is greedy. So I think right now maybe we are in a state whereby everyone is greedy. So perhaps you should be a bit more anxious. But having said that, that doesn't mean you should sell off everything and put everything into cash. But I think a long-term disciplined kind of investment approach will be able to let you do your financial planning more effectively, and also perhaps over the longer term you'll be able to achieve the kind of return that you're targeting to to achieve. So currently, I would say that if you are kind of exposed to the market and maybe overweight equities at this point in time, perhaps you may consider trimming some exposure, but I think you should still retain exposure. There is also opportunity in the fixed income space as we have seen, interest rates staying higher. But then, having said that, there's also a lot of things happening in the fixed income space in terms of the yield curve. So there could be opportunities whereby as the yield curve normalizes or flatten, because right now you just put all your money in the short term and you actually make a lot more money by buying a 10-year or a US, let's say, government bond. But I think as we see shorter term interest rate coming down, I wouldn't want to estimate like how much it will go down. But as the yield curve flatten or normalize, I think there will be opportunity to make some decent money in the fixed income space. So in short, I think a good allocation between equities and fixed income would be a very prudent strategy going forward into 2025 or beyond.
Thank you, Kenny, for sharing invaluable insights, and thank you, Marcus, as well, for co-hosting this episode with me. With Trump's return to office, it definitely will signal some changes in policies as well as market dynamics. But as always, understanding the bigger picture is the key to staying ahead. Thank you, everybody, for tuning in to this episode of the Global Fund Voyage podcast. We'll see you at our next episode. Until then, stay informed and stay invested. Wishing everybody a very Merry Christmas
and a Happy New Year.
Bye.